the Indonesian stock market, it actually halted in twice. So the first FT article on the left hand side is on the 28th, a couple days back. And then the one on the right is literally the very next day. Goldman Sachs adds to some of the warnings that MSCI voiced, and we saw another exchange halt. So Matt, kind of you mentioned to me you're seeing signs of something going on here. So I'm curious, how does this tie into the broader kind of Asian markets and exchanges?
Yep. So if we're going to touch this one very quickly, Indonesia not on everybody's radar, but I want to call it out as an INR, or sorry, INW, indication and warning of basically a light flashing on the dashboard. Hey, let's check liquidity conditions here. This was our a story here we had in the block to cover before the big news of Kevin Morris today. So very quickly, just to go through what's happening. Yeah, Cameron mentions it. I think it was two occasions trading was halted on the Indonesian stock exchange. Why does anybody care about the Indonesian stock exchange? In terms of Southeast Asia, equity markets, um, and I'm not including the basically the more eastern countries, you'd say like Japan, South Korea, Taiwan, China, which tend to have a little bit more tech exposure. So we even American investors would pay attention to those equity markets a little bit more. These would be more like the Southeast Asian economies. There's not so much, not as much going on in terms of tech, semiconductors, et cetera. So they're not really like taking a front and center role over like as they are in Western media, talking about GPUs, supply chains, Taiwan semis, Samsung, et cetera. But Indonesia is the largest stock market by capitalization across, say, Vietnam, Philippines, Malaysia, Thailand, and Singapore. Singapore is, as a global financial center, very important. But this does show up in terms of almost $1 trillion of market cap. Now I know in terms of market caps, $1 trillion is at this point, you're not a Mag 7 anymore. You're below the cut for one of the largest companies in the U.S. S&P 500 index. Maybe you're somewhere in the 10 to 50 range is what $1 trillion would rank you at today. But what this represents in terms of liquidity, right? So I don't want to spend too much time here, but 1998, the Southeast Asian financial crisis, which I actually talked about a little bit in the Fed just discussion, like you had some problems that really amounted to cross-border linkages and lending. There was a buildup as Southeast Asian or growth was very rapid in these economies. And like basically you saw a lot of dollar-based borrowing to fund this economic growth, which ultimately like collapsed as the tide went out. You had a lot of bad credit problems. There was a true like currency level crisis, which means think about a financial crisis when it hits your bank. That's one thing, or your commercial banking sector, your financial sector. That's one thing. Kind of what the U.S. looked like in 2008. But once it starts to hit your central bank, your currency, and your sovereign government, like that's a next level kind of acuteness like stage of that same problem. So if you look at Indonesia in particular, they've implemented some moves, basically swinging the pendulum from one end where they were at in 1998 to the complete opposite in where we stand today in 2026, like looking at what banks are allowed to do in terms of lending, right? And within Indonesia, they've really shifted from relying on foreign capital inflows to support their targeted economic growth to focusing on the domestic market. But they've also done things like implemented like legal measures where it makes like bankers legally like liable and like criminally punishable for bad credit lending. So what you're actually seeing in Indonesia is kind of it's a monetary system, it's a liquidity tightness, but it's generated by policies that are on kind of the other end of the spectrum than we've seen with like kind of monetary profligacy we've seen out of, say, the United States or something like that, like QE, that type of central banking, the Japanese model. But one of the things I'm looking for, right, if we're looking for like a tightening in global liquidity conditions, at some point you should see this show up in financial sectors, insurance, somewhere. And so far, it's been hard to see. Bank stocks, across the world, they performed well since I'd say since 2023, the U.S. Mini banking regional crisis, which we'll touch on a little bit in a second. But what you're looking for, signs of stress, the Indonesian banks are definitely showing that at this time. It's got their own unique circumstances. It's primarily domestic, but the halting of trading in the equity market says that's a flashing red light. There's a shortage of liquidity in one market. This is a country that's tried to self-contain its own financial system to avoid those cross-border complications that can like burgeon into something like we saw in 1998. But now we're seeing similar on the kind of the mirror image, if you will. So I would say, and the banks in Indonesia, the largest would be call it the Bank of Central Asia. Like I would think of Central Asia being somewhere in the middle of the giant landmass, in Kazakhstan or something like that. That's not actually where the Bank of Central Asia is. It's in Indonesia, believe it or not. But you've seen stocks and their financial sector down 57% at this point in terms of drawdown in local currency terms. So that just tells you that's a big pullback in the financial sector. It's a symptom, not necessarily the cause of counterparty risk and escalating contagion. But I do think it's pointing us in the direction, hey, we should be looking for signs somewhere else. If there is stress involved, what could actually be providing the knitting to patch some of these different exposures where a pop-up could materialize further. And that's where I think could take us into what we saw in the Japanese bond market. This was, I think, January 20th. We had two back-to-back days where the long end of the JGB, the 40-year maturity, rose by about 40 basis points in 2 days. This is something at Davos. Scott Bessent commented, hey, this is the Six Sigma standard deviation event. So I think it's first important to identify what in the world is going on, because most commentary, if you see it in your news feed, your social media followings, et cetera, they haven't talked about anything in depth as far as what is the actual problem here. They just talk about, hey, Japan's coming off 40 years of QE. This thing's going to rupture. This thing's going to burst. Get out, flee for the hills. So I'm going to go over a little bit of what's actually happening so we can hopefully get our bearings and then understand where we are, understand your environment so that we can position ourselves with a framework to help us in the next coming weeks, maybe months, as this material or this situation may materialize into something bigger than what we've already seen, which I'll say so far in 2026, like we've seen nothing yet, despite all the headlines we see, the volatility. As far as financial markets are concerned, we haven't even seen the fireworks go off, in my opinion. All right, so just set the backdrop. Cameron, you pulled this article. Going back to November, Japan announces 135 billion stimulus and bid to support economy and consumers. What you're looking at here in Japan, after 40 years, you've got inflation rising, right? And it's elevated. And it's at the point where the Japanese sovereign debt market, which were basically trapped at zero, even negative interest rates out to, let's say, 10-year maturities, like just craziness. Because consumer prices are rising, people are stressed, their money isn't keeping up with the debasement. So yields have to rise in order for the money to basically stay on the rails. So it comes down from a Japanese internal perspective. If you let this keep going, money dies, your civilization goes into basically chaos as internal political economy and order fragment. A new order has to emerge. That's a volatile, violent process. Nobody wants that. So from the Japanese standpoint, yes, there is something new coming. There is going to be a shift in the monetary system, both in Japan, United States, everywhere. I think that's clear. From Japan's internal standpoint, you want to let this happen in such a way that you can maintain internal stability to the greatest degree possible. And that's where you get into this situation. I mean, you can see this in the U.S. as well. You see threats from within, threats from without, all of that. There's when we're in these moments, it can be a free for all. But Japan so far, the Takahashi government, they are trying to do this, in my opinion, in such a way that preserves societal and cultural stability. All right, and that's where the 135 billion in stimulus support that comes in. It also explains why the LDP with the new Japan Innovation Party as junior partner with this new coalition, they've called new snap elections on February 8th, basically to consolidate political power internally. In my opinion, you do this to have the votes, have the governance power and authority to address a potential flare up as, say, maybe a crisis emerges, if one emerges. All right. So, talked about the snap election. What you're looking at in Japan, you've got volatility, not just the JGB sovereign debt mark, but also dollar yen. So things are operating like on a knife's edge right now. It's touch and go, to make a saying. So what's the root cause here? And this isn't just coming up, the meme of the old guy with gray hair holding a coffee. He's like, I'm an expert on repo markets today, or I'm an expert on the current thing. What's actually going on under the hood? Like, if you talk to the expert in gray hair, within the next few weeks, I believe it will trickle in. The core of the problem right now is actually forced selling from Japanese life insurers. So what happened over the Nikkei collapse in the early 90s? Basically, you see a decline in interest rates as growth stalls out, credit creation dries up, bad credit from the speculative real estate boom in Japan have to be digested and dealt with. Remember the famous anecdote, right? If you looked at the land around the Japanese Imperial Gardens in Tokyo, it added up to basically the entirety market value of the whole of the state of California itself, right? So it was massive speculative bubble. We had to deal with the unwind, right? So interest rates collapse. At the same time, you've also got the demographic trend where population growth stalled out, birth rates declined below replacement levels, and you've got a gradual like aging taking place in the demographic curves for Japanese society. So what people did in that environment, you go to the bank deposit. If you want to park your savings there, they'll pay you zero. If you want to buy a Japanese government bond, you're going to earn negative. The product that filled the space or filled the need for those aging kind of retirement savers were life insurers with annuity and whole life products. So they were able to promise like 1 to 2% yields, which if you're a Japanese, citizen at those times, you need retirement, you need income, you need savings. Stock market was in a bear. Like it was like, if you go back and look at the Nikkei, like collapse, and it's just now in the last couple of years returned to an all-time high. This is like great. This is like people surviving in the U.S. the Great Depression in the 1930s, 1940s. They didn't come out of it, and from a balance sheet perspective, come out whole until like 1970, 1980. Like it's crazy how long it took. But like when you look at the numbers in nominal and real terms, like it eats up half your life. But what happened is instead of like flowing your savings into the banking system or sovereign debt, the life insurers built products to serve them. So you pay 1 to 2%. Then you look at how did they actually do that? Well, they were buying things like utilizing other currencies, going out and buying, say other debt, U.S. dollar denominated, could be, or euro, et cetera, anything higher yielding. And that's what you would do to support your 1 to 2% payout rates to your future annuitants, I think would be the term, right? So what's going on now as yields come up, as um, the price levels, CPI in Japan has been riding hot above target for multiple years now, basically like 3, 4 years, et cetera. Government bond yields have had to come up in response. What that is saying in like practical effect is that the real goods and services economy, as well as the supply chain infrastructure that's built out for international trade, that was the post-war kind of economic order, and then also the financial system, the global dollar system, and then number two on that list would be the Japanese yen as a funding currency to support borrowing and capital for funding schemes that required
This is the
it.
carry trade people
Um,
talk about.
yeah, those two things are going away. So the dollar, we've seen the tear down in the offshore dollar financing scheme, starting with the launch of SOFR in 2018. Then we get into hiking rates in 2022. You get things like the deprecation of LIBOR starting, I think it was last year was the final, but it's over. No more publishing LIBOR. So the US dollars offshore capital pool that financed the global credit bubble, that made the whole post-war economy and financial system possible, that's gone. So number one source is off the board. Number two would be the Japanese yen. That's your secondary pool, right? So that's going away and we're in process. So if you make the analogy to where Japan is right now on its own journey, I think we're at that point. Like if you look back at the curve of the Japanese 10-year, or you can look at the 40-year, you see the chart. Yields bottomed in 2020. They don't go like sell off like, all right, the bears have won here. Rates are going higher. That doesn't like become markedly clear until you see the transition away from Kuroda as their Fed chair to the new Ueda kind of Bank of Japan governance era. At that point, you start to see this repricing of Japanese government debt taking place, right? And so basically, yeah, 1 to 2 years in that process allowing to play out. What you're trying to do here is let the reset happen. There's going to be volatility that shows up, but you don't want to make it so volatile that like, hey, something collapses. Oops, that's going to topple this process, makes our problem worse, etc. So the analogy I make, I think, to where Japan is right now with the life insurers looks a lot like where the U.S. was with regional banks, some crypto-friendly banks, and it ultimately spilled over to a GSIB in Switzerland, which was the target. Someone wanted a piece of that with Credit Suisse, and there were strategic and geopolitical moves there made as well in terms of my understanding of what actually went on. But if you're looking at Japan's situation, I think to make an analogy, what the dollar went through domestically or due to like domestic kind of volatility in its own financial system in March 2023. I think we're looking at something along those lines with Japan and its own kind of a little slice of its own, domestic financial system with life insurers. This could also spill over. I'm hearing chatter about like some regional banks, like those who primarily serve populations not in the major metros like Tokyo, Osaka, Kyoto, stuff like that. They're focused on the smaller towns, which are in general kind of losing the young population. They're full of kind of aging retirees who are naturally either going to kind of die out or age out of the annuity policies, or they're naturally surrendering those policies, giving inheriting the proceeds if they don't no longer need them to their children, who tend to live in the larger metropolises, and those deposits tend to flow into your large Japanese banks. So this isn't like a 2008 type of environment in the U.S. when it was your it was your GSIBs who were under threat. It looks more like the March 2023 U.S. mini banking crisis, in my opinion. So in net here, I kind of explained this, but let's say you're a retiree, you bought a an annuity from a Japanese life insurer back in 2004. It's going to pay you 1 or 2%, but now you can go out. You can if you um, take a surrender charge, you can recall your money from that life insurance. It'll be a penalty, something like 5, 10%. It'll cost you to get your savings back, but you can call it, and then you take that money, you park it either in a bank deposit at a large Japanese financial like Mizuho, etc. Um, you'll earn higher yield than that 1 to 2% now, as even short-term rates in Japan, like I think they're at this point up to 75 bips. Next hike will take it to 1%. They're going to keep hiking, right? We're nowhere close to the annualized run rate on, price level, inflation in the real economy. So this problem will continue to not just exist, but it'll actually get worse as rates have to rise further. Um, and then you could also, if you're a Japanese, saver, there's also the kind of the trend like we saw in the United States with Treasury Direct, where households can go out now buy treasuries directly, as opposed to, hey, you can still buy them from a broker dealer. Not everybody has a stock account or a brokerage account in the U.S., although that's pretty popular. And the same way in the Japanese economy, there's also a trend. You can go buy a Japanese government bond. So if a saver now sees, oh my gosh, 3, 4% on a Japanese government bond, they're incentivized to go do it, right? Like you can literally like take a
Yeah.
10% haircut, but you're literally going to get, double, triple your annual income. Um, and so even though you're still in a duration headwind environment, as rates are cyclically still on their way up in Japan, people will still do it. There's still a huge
Like
incentive to
comparative
do
to
it.
what
So
they
that's
have,
where you
yeah.
get into yeah. So that's where you get into the effect for every 100 bips of increase on the Japanese government bond yield curve. I saw an insurance, publication that said the surrender rate for these life insurers goes up by 25 basis points. So what this is actually doing, like the way it materializes, if you're an insurer, what you want to do is what's called ALM, asset liability matching. You want your assets over here, your duration, to match the duration of your liabilities during the secular. It's a hard thing to do. Like it's hands-on work. You don't just set it and forget it. This involves trading, interacting with capital markets, hedging, all of the above. It takes real professionals to do this. In a bond bull market, when rates are headed on their way down, it's not a hard thing to do, right? And what you saw from the life insurance industry going into this was that the duration mismatch between assets and liabilities was at like 4 to 5, which basically meant as rates were declining, the value of the assets would increase faster than the value of the liabilities. So on net, as an equity holder in a life insurer, you like the great bond bull market. Now, however, with the rising rate environment, that positive 4 to 5 on the duration mismatch has flipped to negative 1.5, which means actually as interest rates go up, your duration mismatch gets worse. Um, so what's happening is like, yeah, you're slowly eating into the equity capital for the ultimate owners of these life insurance entities. And that's where you start seeing things like January 20th, those 2 days where we saw 40 bips of sell off, the Six Sigma move in the Japanese debt markets that Scott Bessent talked about at Davos. What that is that's forced selling. And research from Goldman Sachs says they point to life insurers who they're forced sellers of their long term bonds that they accumulated a stockpile of in the 40-year, or call it a 30-year secular bond bull market in in Japan, starting with the collapse of the Nikkei. But yeah, that's where we find ourselves today. So if you look for the stories, you want to see what's around the corner. This is actually fascinating when you want to think about the linkages here. So we've seen in private credit, right, in the last 6 months, that bullish, 2022, 2023, 2024, the golden age of private credit, where everybody was talking about, right? The tenor has definitely changed, right? And the underlying backdrop of the private credit market. You've got you go look at Apollo, KKR. I know Apollo, I've been following this chart, peaked in December 2024. It's been in a retracement since. So it looks like the bid, at least as far as Mr. Market, has pulled back. They're preparing for something. There's some sort of event that'll hopefully put in a bottom. Um, but what you're looking at here, if you dive into the Japanese life insurers trade, a lot of the reinsurance risk that they pass on, the largest holders tend to be tied to the US private credit industry. So you'll see Apollo Athene mentioned here, you'll see KKR heavily. You can follow these individual names, but this is connecting the US to what we're seeing in Japan as they go through that repricing of their own sovereign debt markets. But my point here, I'll get across the connections. We're looking at cross-border capital here. So you're seeing the U.S. private credit issuers combined with the Japan life insurers, and then you've got their offshore reinsurance arm. So Athene would be tied to Apollo. They've officially merged here in the last few years, but basically their business model, Athene, is also an annuity issuer. Same thing or similar to what we saw with annuity issuers in Japan. But this whole triple concoction, watch in the weeks and months ahead. If this does continue to materialize, I would expect you to start hearing more and more in the headlines about the Bermuda Triangle. Is how this story will probably be referred to.
Yeah.
Now, how do you address this from a policy standpoint? This isn't 2008, in my opinion. Japanese civilization isn't going to collapse because of 1 to 2% annuities. 2023 in the US, the Powell playbook, what we did, we launched the BTFP that allowed banks in the US, or the regional banks, to as their own bond holdings were selling off, interest rate volatility was showing up in markets. What we did was we created a facility that would allow the banks, so that instead of having to force sell their loans, bonds, credit assets into a volatile market, ultimately exacerbating the problem, making things worse. What he did was, or what Powell did, was launch the BTFP, which basically allowed them to post what the system would view as good assets. Now, that's arguable, right? When we talked about the history of central banking, did we actually create good assets? That's up for debate. But for this exercise, let's just assume the government bonds and then associated agency debt relate, like government approved borrowing under other programs, authorities, agencies, et cetera. Those those loans, bonds, et cetera, were allowed to be posted to the Fed as good collateral without taking a haircut on the loans. This is where he got it wrong when we go to Badgett's quote: "Lend freely at a high penalty rate," right, in times of crisis. Well, we lent at a very favorable rate. It was the 1-year swap rate based on overnight index swaps plus 10 basis points. That allowed the banking system time to basically borrow, access dollars, pay their liabilities, et cetera, and not have to become forced sellers in the market. It worked, right? By and large, that policy's like it was a success, and it also didn't make the U.S. credit bubble problem any worse, in my opinion, than it had already built up over 40 years from Greenspan era to Bernanke, Yellen, et cetera, as we talked about in the first segment with the new Fed chair news today. Um, but yeah, I think a Japanese program will have to look something similar. Bank of Japan is going to have to create something for both its regional banks. They call them shinkin banks, which are basically, think of them as credit unions in the U.S. is a good analogy. So they're not necessarily banks. They don't, post reserves at the central bank, et cetera. And then also the insurance segment. So it'll probably, the ideal will look something like the BTFP, but maybe even a little more longer term duration than just 1 year, maybe two, three, something like that. Um, and then because of the linkages between the Japanese, non-bank financials in terms of funding and reinsurance risk, it spreads over into the U.S. with private credit, which the U.S. commercial banks are heavy lenders into the private credit industry. They're levered 2 to 1 as opposed to a bank, which is 9 or 10 to 1 typically. So it's less of a credit concern, but still, these
Still levered.
cross-border decisions that have been made over in Japan. Like now we're on the way down the mountain. We walked up the mountain, the hard part. If you're ever in mountain climbing, um, up takes a long time, but down is slow and fast. Or no, sorry. Down is like fast and takes a lot of energy. It's harder than you think, right? Slow and fast. It doesn't make any sense. Like ignore that. But the way the descent down the mountain is what tends to be fast. And takes a lot more energy than you would think. So for that, yeah, and then also the other leg of the insurance triangle is the offshore reinsurance market. I mean, this is just the global pools of capital. Obviously, Bermuda is not going to have the GDP, the resources flowing through its domestic banking system to bail out a crisis if one occurs. So that triple-legged stool, I think you're looking at for Japan to make it out of this. Maybe Japan, if it were by itself, they wouldn't be able to come up with the policy prescriptions to navigate this turmoil. But I think what we're going to see is a test, and when you have the U.S. plus Japan, and could be other private capital players globally as well, who are aligned with that sovereigntist movement. I think that's enough to get this done. But I think, yeah, the coming days, months, weeks, you could see a volatility event. Um, January 20th, that might have been just the initial signal. You're seeing other signals go off. Same thing like the Indonesian market close. These things under the hood, they're related in the financial system. So you're
Right.
seeing a pull for liquidity. Um, that's a sign. Watch out. End of quarter. Like by the time we get into March, that's when these things can develop to a head. So we'll keep watching this closely.